The IRS fired 30,000 employees last year. 30,000. That is 31% of the people who conduct audits. Gone. So you would think the chances of getting audited just got a whole lot lower, and you would be half right. Audits are down. But enforcement revenue is up 12%. Fewer people, more money collected. How is that possible? The answer changes everything you thought you knew about how the IRS actually works. Here is what happened. The IRS went from over 100,000 employees to around 77,000. It opened around 205,000 audits in 2026, down from 335,000 the year before, down from over 1 million a year just a decade ago. Fewer audits, more money. The math does not add up until you understand one thing. The IRS has deployed over 125 artificial intelligence and machine learning models to analyze returns, detect anomalies, flag fraud, and prioritize enforcement, up from just 54 in 2024, up from just 10 in 2022. The agency is not casting a wider net, it is using a smarter one, and the returns getting caught are not chosen at random. They are the ones that scored highest on a system most Americans have never heard of. It is called the DIF, the Discriminant Index Function. The moment your tax return hits the IRS system before any human being reads a single line, a computer gives it a score. That score decides everything. High score means a human reviews your return. Low score means it passes straight through and you never hear a word. The DIF is a computer program that searches returns for values that are unusual in light of historical data. And in 2026, that system has been upgraded with machine learning that compares your specific deductions against what is normal for your exact income level, your occupation, and your zip code. If you are a consultant claiming 80% of your income in travel expenses while the industry average is 20%, you will trigger an automated notice. The algorithm does not care that your expenses were real. It cares that they are unusual. And unusual means flagged. Think of it this way. There are fewer police on the highway than there have been in decades. But the speed cameras are everywhere, and they never blink. So what does a high diff score actually look like? What patterns is the system trained to find on your return right now? There are 5, and at least one of them is probably something you have never thought about before. The first pattern is income that does not match what third parties already reported to the IRS. Here is something most people do not fully appreciate. The IRS already has your financial picture before you file a single word. Every employer files your W-2. Every bank reports your interest. Every brokerage reports your capital gains. And starting in 2026, every crypto exchange now files a Form 1099-DA for your digital asset transactions. The IRS has all of it. When your return says something different from what those institutions already reported, the automated underreporter program flags the discrepancy before any human gets involved. In fiscal year 2024 alone, that program generated $7.7 billion in additional tax assessments. $7.7 billion. From mismatches, not from fraud investigations, from mismatches. The second pattern is deductions that are disproportionate to your income. The DIF score flags returns where deductions look outsized relative to what someone at your income level would typically claim. Charitable contributions exceeding 3 to 5% of your adjusted gross income. Home office deductions, especially when combined with a regular W-2 job. Business meal expenses that seem excessive for the size of the operation. None of these things are illegal. But they are statistically unusual. And statistically unusual is all the algorithm needs to put your return in the review pile. The third pattern is round numbers. This one surprises people. Using round numbers, $6,000 for advertising costs. $4,000 for transportation expenses tells the algorithm you are estimating rather than recording. Real expenses rarely end in perfect zeros. When they do consistently across multiple line items on the same return, the model flags it. The IRS AI systems are specifically trained to detect estimation patterns. If your deductions look like they were guessed rather than measured, the score goes up. The fourth pattern is self-employment income. If you file a Schedule C, you are automatically in a higher scrutiny category, not because you did anything wrong. Because self-employed underreporting constitutes the largest portion of underreported individual tax liability in the entire country. The IRS knows this. The algorithm waits for it. 2 separate AI models now specifically target self-employed taxpayers and small business owners. One compares your line item deductions against what the model expects for someone in your profession. Line items with greater deviations from the expected amount are marked high risk. The 5th pattern is lifestyle data. This is the one that catches people completely off guard. The IRS AI Now Cross references your reported income against public data, luxury asset registries, and in some cases public social media activity. If you report $40,000 in income but just registered a $120,000 vehicle, the system flags a lifestyle discrepancy. Property purchases, boat registrations, high-value insurance policies, all of it feeds into the picture. The algorithm is not looking for criminals. It is looking for anomalies. Returns where the numbers on the page do not match the life being lived. And here is the honest truth that most financial content never says out loud. Many audits triggered by these systems result in no change to the return, or even a refund. The person being audited did nothing wrong. Their numbers just looked unusual to a machine that had already read millions of returns before it read theirs. The goal is not to cheat less. The goal is to look less unusual, and those are 2 completely different things. So, what does all of this actually mean for how you file? 3 things. And none of them are complicated. The first is match the data the IRS already has. Before you file, pull every document that was also sent to the IRS. Your W-2s, your 1099s, your brokerage statements, your crypto transaction reports. Go line by line and make sure every figure you report matches exactly what those documents say. The automated system catches mismatches before any human gets involved. And once it catches one, a human does get involved. Do not give it anything to find. The second is make your deductions specific. Not round. Not estimated. Actual amounts with actual records. A mileage log with dates and destinations. Receipts with the business purpose written on them at the time. A home office with a measured square footage and a calculation on file. The algorithm benchmarks your deductions against people in your profession earning similar income in your area. If your numbers are outliers, your score goes up. Specific documentation is not just good practice. It is the difference between a return that passes through quietly and one that gets a second look. The third is report everything. Every dollar of income, regardless of whether a form was issued for it. The cash from the weekend market, the Venmo payments for the side work, the crypto you swapped for another coin, the staking rewards that landed in your wallet. Report all of it. Because the IRS is receiving more third-party data in 2026 than at any point in its history. The gap between what they have and what you reported is exactly what the system is trained to find. Here is where things actually stand right now, and it is worth being clear about this. Your statistical chance of being audited is near a historic low. The IRS opened 205,000 audits in fiscal year 2025. For comparison, they were opening over 1 million a year as recently as 2017. If your return is accurate and your numbers are consistent, your audit risk is genuinely low. But the audits that do happen are more precisely targeted than ever before. Former IRS Commissioner Danny Werfel put it this way. Imagine an IRS employee sitting down to play chess against a potential tax evader. And now suddenly you have Ibem Watson on your side telling you exactly how to play the game. That is what AI does. The highway has fewer patrolmen. But the cameras have never been sharper. Fewer audits. Smarter selection. The returns getting flagged in 2026 are not being chosen at random. They are the ones whose numbers told a story that did not quite add up. Your job is simple. Make sure your return tells the same story as the data the IRS already has. Match every number, document every deduction, declare every dollar. Do that and your return will score low. Pass through quietly, and you will never have to open one of those letters. If this opened your eyes about how the IRS actually works, Hit subscribe and turn on notifications. A new video drops every week on building real financial knowledge in America.